So section 1.2 is business transactions, and if you're following in your textbook, it's on page 15 to 28. Every business, the purpose of having a business is to make money. In order to make money, there has to be things happening in your business, and when that happens, we call those a transaction. So in this section, we're going to talk about recording transactions. And of course, every time something happens in our business, it's going to affect our assets, our liabilities, and our owner's equity. We want to make sure that we still have mathematical accuracy, and we're going to be using a transaction analysis sheet to help us keep track of our transactions and at the end be able to figure out if we are in balance. We also need to talk about accounting standards and code of conducts of accounting professionals. Okay, so with the transaction, something of value is either given or something of value is received. The balance sheet provides a detailed picture of the financial position of the business, and at the end of the business day on a certain date, the same information is represented in a summary form by the balance sheet equation. Now, we didn't talk very much about this last day, but our balance sheet equation is that your assets have to equal your liabilities plus your owner's equity. Or another version that people like to use is assets minus liabilities equals owner's equity. So basically, what you own minus what you owe equals your owner's equity. A transaction analysis sheet will be used to assist in the examination of the transactions. Now, there isn't an accountant in the world that still uses a transaction analysis sheet. It's not actually considered to be a proper document. It's just something that's going to help us analyze what we're doing, and it's used to teach you. We're also talking about accounting period, which refers to the length of time between the preparation of financial reports. So for most companies, they will prepare their financial reports every month. And at the end of the year, they will summarize everything and send it off to their accountant to have it filed for income tax. Okay, so on the bottom here, this is what your transaction analysis sheet will look like. It has your assets on the left, your liabilities, and your owner's equity on the right. What you do is you take what you have in your balance sheet and you're going to transfer it here to your analysis sheet. So you see that cash is starting with $5,000, accounts receivable $6,000, office supplies $500, land $25,000, a building worth $110,000, physio equipment $63,000, and office equipment $31,500. The liabilities that this Physio Central owe: accounts payable $4,000, bank loans $65,000, mortgage payable $80,000, and the capital of Prea Ramdas at this point is $92,000. Okay, so that goes on the very first line of your transaction analysis sheet. So we're going to look at 3 transactions to start with. The first one, purchase new physiotherapy equipment for $500 cash. For every transaction, you're going to ask yourself these 4 questions, and then you're going to decide how it is going to be affected on the transaction analysis sheet. The 4 questions are, which items change in value as a result of this transaction? And always remember that there has to be at least 2, because the equation needs to stay in balance. The assets still have to be equal to the liabilities and the owner's equity. So every transaction, it needs to stay in balance. The second question you ask yourself is, by how much do the items change? And do the items increase or decrease in value? And after the change is recorded, is the equation still in balance? So these 4 questions are going to happen very quickly with each transaction. So you're purchasing new physiotherapy equipment for $500. So you know that's going to affect your cash, and your cash is going to go down $500. The other thing that's going to happen is you're gaining physiotherapy equipment, so it's going to go up by $500. And do you see how both transactions were on the left-hand side on the assets? One went down, one went up, meaning the transaction is still in balance. And then what you need to do is make sure you put your new balance for each account. And if nothing is happening in that account, like as in here, the $6,000 accounts receivable, the value just continues to carry forward. Bought office supplies for $55 on credit for Central Office Supply, or sorry, from Central Office Supply Company. The on credit is an important clue. So nothing is coming out of your bank account at this point, so cash will not be affected. Your office supplies are going to go up $55. And your accounts payable, because now you owe more money, is going to go up $55. And if you look at the equation talking from the left side to the right side, so if I were to draw a line straight through the equal sign, the left side went up 55 and the right side went up 55. Therefore, it's still in balance. So you know that you have done this correctly and you can keep on going. July 10th, received $3,000 cash from patients. Now that says it's various accounts receivable who owed money. So it's not telling you specifically what patients paid you, it's just grouping them all together. So you know that your cash is going up $3,000 and your accounts receivable is going to go down $3,000. Okay, people owe you less now after this transaction. That's why it's going down $3,000. And if you think of this as being left side and right side, the left side went down and then it went back up. So you're still in balance. Okay, here's some more. I'm going to have to kind of flip between these two pages, so bear with me. July 15th, sold some unused office equipment for $400 cash. I always like to look at my cash first. So if you flip over to here, we're right here. So your cash is going up $400. And because you sold office equipment, your office equipment is going down $400. And if you think of this as being the left and the right side, the left side went up and then it went back down, so it's still in balance. Okay, I'm going to flip back. Paid $375 cash to Central Office Supply Company for an account payable that had become due. So you owed Central Office Supply Company and now you're actually paying them. Okay, and I like to look at this as my cash, $375. So I'm going to flip back to the transaction analysis. My cash is going down $375 and my liabilities are going down $375 because now you owe less money. So if you think of it as the left side and the right side, the left side went down, the right side went down. So you're still in balance. On the 21st, the owner invests an additional $800 cash into the business. Quite often, an owner will take money out of their own pocket and they will put it into the business. When this happens, you don't look at it as the owner's money, you look at it from the point of view of the company. So the company's cash went up $800. And now their owner's equity or their capital is also going up $800. And if you look at it from the left side and the right side, you'll see that the left side went up and so did the right side, so you're still in balance. Okay, and flipping back to July 25th, purchased more physiotherapy equipment for the clinic from Niagara Health Equipment Limited for $3,000. Now $2,000 was paid in cash and $1,000 will be paid in 30 days. So this transaction is going to actually have three parts to it. Your cash is going down $200 and your accounts payable is going up, $1,000. Yeah, so $2,000 and $1,000. And you are gaining physio equipment of $300. So if you want to look at this now as the left side and the right side, the left side went down $2,000, but it went up $3,000. So it's gaining $1,000. The liabilities went up $1,000. So they're staying in balance. Now, if this question were to be done, what you'd want to do is you would total your assets, total your liabilities, and total your owner's equity. Then you would add them, make sure that the two sides are in balance. Now at the end of that, you always want to make a new balance sheet. So I'm going to flip back to here. Do you see these totals here at the bottom and see how they're double underlined to show that everything's in balance? What we're going to do is transfer these to a balance sheet. We already talked about how to do a balance sheet. Okay, and so now it's at the end of the next month. So do you see how the date has changed to July 31st? It has the assets on the left side, the liabilities, and the owner's equity on the right side. Okay, and then the formatting is the same as what you've already learned to do. Okay, so that's a transaction analysis sheet. Just to move into something a little bit different, we want to introduce accounting standards. And accounting standards are GAAPS, which is Generally Accepted Accounting Principles. We want every accountant to have to follow the same rules. Because if they don't, then it's like basically being a police officer and not having a set of rules to hand out tickets or enforce laws. Okay, so you think of this as being kind of the accountant's law book. There are two sets of accounting standards that accountants in Canada follow. One is called the IFRS, which is the International Financial Reporting Standards, and the other one is the ASPE, which is Accounting Standards for Private Enterprises. All publicly traded businesses in Canada must use and follow the IFRS. Private businesses may choose between the ASPE and the IFRS. So a publicly traded company would be something like Tim Hortons, where you could go into the stock market and you could purchase shares into the company. If you are a private business in a small town or in a city, you can decide which accounting standards you want to follow. The important thing is, though, once you pick one, you have to continue with it. Okay, so not really too much to cover there. The global economy. Many Canadian businesses operate throughout the world. They buy and sell products, borrow and lend funds, and have agents and facilities in many countries. Since these businesses operate in the global market, it makes sense for them to use and follow the same reporting and accounting procedures as companies throughout the world. Okay, so I've talked about public businesses and private businesses already. Non-profit organizations are things like charities, schools. They operate without the purpose of wanting to make money. And they actually have a few tax breaks and different rules that they can follow as well. Okay, and as we've talked about already, we also have the business entity principle, and a quick reminder is that basically anything that is your private finances stay separate from your company finances. And if they ever do need to criss and cross, then you just need to make sure that you're recording them. Cost principle, we kind of talked about that already too. Fair value principle. Companies that use the IFRS can use the fair value principle as a method of valuing their property. This principle uses the current fair market value of the assets for the financial reports. We'll talk a little bit about that in a bit as well. Okay, so here's a summary of basic accounting standards. We don't get into great detail in Accounting 10 with these, but you should know what they are and which kind of companies use them. Okay, big thing in accounting is business ethics. Teachers have business ethics, doctors, lawyers, accountants, any kind of a professional has a set of ethics. In business and accounting, there are a number of controls that encourage people to do the right thing in carrying out their everyday activities. We have business ethics, we have the law, we have professional standards, we have accounting principles and standards. They're kind of guidelines to make sure that everybody in these professions are caring about their business in the most respectful manner. Consider this situation. A salesperson in an electronics store tells a customer who's looking for a laptop computer with a high capacity battery that the battery in a particular unit on offer will last 10 hours without charging. The customer is impressed and buys the laptop. The salesperson is happy and has earned a good commission. The salesperson also knows that the battery in the unit requires charging after 6 hours of use at best. This example illustrates the need for businesses and their representatives to act and to make decisions in an ethical manner in all aspects of their work. So business ethics is the study of ethical dilemmas, values, and decisions making into the world of business. It involves decision making according to moral standards. It involves principles that govern the choice made for right conduct. It involves doing the right thing rather than trying to fool people. Okay, so every different profession has their own code of ethics, and it's just meant to guide their employees. So here are some basics that you might see with a code of ethics. General employee conduct while at work. They will explain what is expected of them. We also have gifts. It will explain if employees are allowed to receive gifts from clients or suppliers. So in gifts, there may be saying, here, I'll pay you $1,000 if you kind of forget that this transaction happened. Okay, that would be considered unethical. Confidentiality. We have lawyers, we have doctors that need to make sure what is said to them is kept confidential. Conflicts of interest. So that just means that if you are involved in a certain company, personally, that you won't be the person making decisions for that company if you happen to be their accountant. Relationships with customers and suppliers, so same thing, just making sure that people aren't bribing and whatnot. Entertainment, define the types of entertainment activities that are allowed. And unethical behavior, yeah, that's pretty straightforward. And use of organizations' assets for personal activities. So some companies won't allow you to take home company assets and use them for their own personal use. So you have to kind of check into that with your company as well. Okay, we also have the law. So if you're breaking the law, then of course that goes through a whole different channel. But if it's a professional standard, then that stays within your profession. They handle the standards on their own. And accounting standards are the standards that we use in Canada. Okay, so that is the end of this lesson.